Okay, I want you to forget everything you think you know about what's coming in the next few years. Because 2026, it's not just another year on the calendar. No, it's a collision point. We are about to see a full-blown AI infrastructure build-out, a brand new global rulebook for crypto and digital assets, and an economy that is just groaning under the weight of historic levels of debt. The old playbooks, let me tell you, they're not just outdated, they are flat-out dangerous.
And that brings us to the one question that every single investor, you, me, everyone, has to answer right now. When these massive, titanic forces slam into each other, how in the world do you find your footing? How do you protect your capital, let alone grow it, when the very definitions of risk and reward are being rewritten in real time? Well, that's the puzzle we are going to solve together today.
So here's our roadmap. We're going to start with a big picture, the macro headwinds that are setting the stage for everything else. Then we'll dive right into the disruptive and, let's be honest, chaotic frontiers of AI and crypto. From there, we'll get tangible and look at real estate, which is facing a historic moment of reckoning. And we'll wrap it all up by giving you the new rules of risk, the modern toolkit you need for this crazy, uncertain world.
All right, first up, the macro headwinds. Look, before we even dream of talking about a specific stock or an asset, we have to understand the environment we're in. You know, the powerful ocean currents of policy that everything else is floating on. And believe me, in 2026, this isn't just some background noise. It is the main event.
I love this analogy because it just cuts through all the financial jargon. Think about it this way. The Federal Reserve is the doctor, and the economy is their patient. Now, when you see a doctor suddenly resort to really extreme measures, like the financial version of full-throttle medicine, it tells you everything you need to know about how sick that patient is. The more dramatic the intervention, the more serious the underlying illness. So, by watching the treatment, we can diagnose the disease.
And this timeline right here shows you just how pivotal 2026 is for regulation. Kicking things off, on January 1st, we've got the Crypto Asset Reporting Framework, or CARF, going into effect. This completely changes the game for crypto tax, globally. Then, by August, the EU's massive AI Act becomes law, creating this super strict top-down rulebook, which, by the way, clashes pretty hard with the US approach. And speaking of the states, all year long legal battles are creating this messy, uncertain patchwork of rules. The takeaway is simple. For both AI and crypto, the Wild West era, it's officially over.
So, with that regulatory backdrop in mind, let's dive into the two frontiers that are just dominating the headlines and, of course, our portfolios: AI and crypto. You know, the challenge for any investor here is huge. How do you tell the difference between a true technological revolution and just another speculative bubble that's about to pop?
To really get a sense of the scale of what's happening here, just look at this number. $2.52 trillion. That's the projected global spending on AI in 2026 alone. And this isn't just about software licenses. A huge chunk of this is a massive capital spend, a build-out of actual physical infrastructure like data centers, servers, and semiconductors. We are literally witnessing one of the fastest and largest industrial buildups in history.
And this slide just perfectly illustrates the huge conflict facing investors. On one side, you've got these seasoned, respected asset managers like GMO calling this an extreme bubble. They're saying it's just like the dot-com era and it's going to end in a painful crash. But then on the other side, you have giants like BlackRock arguing, no, this isn't a bubble. This is the necessary investment for a productivity revolution. They're essentially saying, yeah, the price tag is high, but the payoff in long-term economic value will be even higher. So as an investor, you have to decide which one of those stories you believe.
So where is the tech itself actually headed in 2026? Well, the keyword you need to know is agentic AI. This is the next big step. We're moving beyond AI that just answers a question to autonomous agents that can tackle complex, multi-step goals all by themselves. We're talking about AI like Devin that can take a software project from an idea all the way to completion, or Harvey, which can do incredibly sophisticated legal research. This shift from a passive tool to an active agent, it's a fundamental leap we all need to watch.
Now, let's circle back and look a little closer at that CARF regulation for crypto, because this is a seismic shift. Starting in 2026, in over 75 countries, crypto exchanges will be required to collect all of your transaction data. Okay? Then that data is automatically beamed over to your home country's tax authority. Let me be blunt about the takeaway here. The idea of using offshore exchanges to stay private, that's effectively dead. The era of regulatory gray areas is over. And this chart right here perfectly illustrates another huge shift in how we have to think about crypto. For years, the story was that it's digital gold, right? A safe haven asset totally separate from the stock market. Well, the data in 2026 tells a very, very different story. Crypto now has a 70% correlation with stocks, meaning it behaves much more like a high-risk tech stock. When the stock market sells off, crypto sells off. It is simply not the defensive asset that many people once thought it was.
Okay, let's pivot from the digital world to the physical one. Let's talk about the one asset you can actually stand on: real estate. And yeah, most of the headlines are screaming crisis, but we're going to explore the contrarian view and see how some of the smartest investors out there are actually seeing a once-in-a-generation opportunity.
This is the number that is keeping commercial property owners up at night. $1.8 trillion. That is the wall of maturity. It's the mountain of commercial real estate debt that was borrowed at super low, almost free interest rates years ago, and it's all coming due for repayment or refinancing in 2025 and 2026. And the killer is, they have to refinance it at today's much, much higher rates.
So this creates a massive problem called the refinancing gap. Here's how it works. It's pretty simple. Let's say you have a $10 million loan from 2020 that's coming due. You go to the bank to get a new loan, but because interest rates are way higher and maybe your property value is a bit lower, the bank is now only willing to lend you $7 million. That $3 million shortfall, that's the gap. And the owner either has to come up with that cash out of their own pocket, sell the property, or face foreclosure. This is happening all across the country right now. So, how do you turn this crisis into an opportunity? Well, this is where a strategy like the BRRR method comes in. First, you buy a distressed property, probably from a motivated seller who's facing that exact refinancing gap we just talked about. Next, you rehab it, and we're not just talking a coat of paint. This is about strategic upgrades that force its value higher. Then you rent it out, get that cash flowing, and prove to the banks it's a stable, income-producing asset. That allows you to refinance based on its new, higher value, which lets you pull all of your original capital back out tax-free. And the best part? The final R is for repeat. You take that same capital and you go do it all over again. It's a system designed to turn market pain into a personal wealth engine. And this brings us to our final and, I think, most practical section, the new rules of risk. Now that we understand the landscape, how do we actually navigate it? This is all about the specific tools and, maybe more importantly, the mental models that the most sophisticated investors are using in 2026. Before we get into any specific strategy, we have to start right here with psychology. This quote from the Nobel Prize winner Daniel Kahneman explains so much about how we behave as investors. We are hardwired evolutionarily to pay way more attention to threats than to opportunities. A potential loss just feels so much more painful than an equivalent potential gain. It's why fear spreads so much faster than greed in the markets. And it's why having a systematic, logical process for managing risk is the only way to overcome our own worst instincts. And that leads us to maybe the single most important concept for any modern investor: the hunt for asymmetry. The entire game is to find investments where the potential reward is just vastly, hugely greater than the risk. You're constantly looking for setups where you can risk $1 for a credible chance to make $5 or $10 or even $50. It's not about being right 100% of the time. It's about structuring your bets so that when you are right, your wins are exponentially larger than your losses.
So how do sophisticated investors actually do this in practice? A lot of the time they use options. Take a look at the Iron Condor. That's not a bet that a stock will go up or down. It's a bet that it will stay sideways, just churning in a range. You're profiting from low volatility. Or a debit spread. This lets you bet on a stock's direction, but it actually captures your maximum loss to a small, predefined amount before you even place the trade. The other strategies you see here work on similar principles, whether it's profiting from the simple passage of time or setting up a directional bet with almost no risk on one side. These aren't wild gambles. They are financial tools, like a surgeon's scalpel, designed to precisely manage risk and create those favorable, asymmetrical payoffs.
If you take just one thing away from this whole section, let it be this. Successfully navigating the 2026 market is not about having a crystal ball. It is about building a system. It's about replacing prediction with process. So instead of asking, what's the market going to do, you create a series of if-then statements. If this stock breaks its support level, then I will exit my position. If this company's earnings disappoint, then I will reduce my exposure. It's this kind of logic that pulls emotion out of the equation and allows you to execute your plan with discipline.
And that brings us to our final thought for today.
As we look at this incredible landscape of colliding giants, AI, regulation, debt, new technology, the question for you is, how are you positioning yourself? Are you playing offense, trying to find growth in these disruptive sectors? Are you on defense, focused on just preserving your capital? Or, like the tools we've talked about suggest, are you trying to play a totally new game, one that's not defined by prediction, but by process, by asymmetry, and by a deep understanding of the new rules of risk?